So you've sold an asset for a profit. Fantastic. But now you're looking at that capital gains tax bill, and it can take a serious bite, right? Well, what if I told you there's a way you can legally and pretty significantly shrink that bill? Let's get into exactly how you can do that. And we can have this whole discussion today thanks to the experts over at My Tax Accountant. They're absolute pros at helping people across the UK navigate these, let's face it, pretty complex rules. So together, we're going to look at how you can make improvements to your assets work for you. Okay, picture this. You've sold a property, maybe some shares or another big asset. The profit looks great on paper, but then you see the tax bill and you start wondering, is this it? Is there anything I can do to bring that number down? Well, the answer is yes. There's a really powerful, and let me be clear, a perfectly legal tool at your disposal: deducting the cost of what are called allowable improvements. This is absolutely key to keeping more of your hard-earned money right where it belongs, in your pocket. So, what on earth is an allowable improvement? It sounds kind of straightforward, but you know how it is. HMRC has some very specific ideas about what qualifies. Getting your head around their definition is really the first big step to unlocking some serious savings. Right. So, in HMRC's own language, it's a capital expenditure that genuinely boosts your asset's value. But there are two non-negotiables here. First, the improvement has to still be there when you sell the asset. And second, and this is a big one, it can't just be a routine repair or simple maintenance. And listen, getting this right is more critical right now than ever before. Why? Because the capital gains tax annual exempt amount, that's your tax-free allowance, is frozen at just £3,000. It's tiny. That means every single pound you can legally deduct for an improvement makes a real, tangible difference to your final tax bill. Okay, to try and make this a whole lot simpler, we can basically boil down all of HMRC's guidance into 3 simple questions. Think of these as your 3 golden rules, a quick test to see if your expense is on the right track. Here we go. Ask yourself these 3 things. Number 1, was the work done directly on the asset itself? 2, did it actually improve its value in a meaningful way, not just patch it up? And 3, is that improvement still there, reflected in the price when you sold it? If you can say a big yes to all 3, you're in a great position. And this is where that crucial line gets drawn. Let's take an example. Building a loft conversion, that's a classic capital improvement. You've added a whole new feature, you've enhanced the property's value. But fixing a leaky roof or just repainting a room, that's just maintenance. It brings the property back to its original state, but it doesn't enhance it. So those costs, not deductible. All right, so with that big distinction between an improvement and a repair in mind, let's look at a few more real-world examples of what usually gets the green light from HMRC and what doesn't. Generally, we're talking about major projects. Things like extensions and loft conversions are pretty clear-cut. But also think about permanent upgrades, like installing solar panels or even putting in a brand new driveway. And interestingly, things like accessibility adaptations, maybe adding a ramp for a wheelchair, can also count as a deductible improvement. Let's make this real with a quick case study. Meet Penelope Hargreaves. She spent £18,000 installing a solar panel system on a rental property she owned. Now, when she sold it, her gross gain was £425,000. But by deducting that £18,000 cost, her taxable gain dropped in a big way. For her, as a higher rate taxpayer, that one deduction saved her over £4,300 in tax. That is a huge saving from one well-documented improvement. But, and this is probably the most important part of this whole discussion, making the improvement is only half the story. You absolutely 100% must be able to prove you spent the money. And honestly, I can't overstate this. HMRC is incredibly strict when it comes to proof. If you make a claim for an improvement but you don't have the paperwork to back it up, they can, and they will, simply disallow it. And just like that, all your hard work to lower that tax bill goes right out the window. So what does good proof actually look like? Well, you need to build a really clear paper trail. Keep everything. We're talking receipts, detailed invoices, any contracts you signed, bank statements showing the payments going out, and of course, any relevant planning permissions. Scan them, back them up, and keep them somewhere safe for at least 6 years after you sell. Look, as you can probably tell, while the basic idea is pretty simple, getting it right in practice can be tricky. That line between a repair and an improvement isn't always crystal clear, and that is exactly where getting some professional advice can be worth its weight in gold.
So if you're looking at a capital gain and you want to be totally sure that you're claiming every single deduction you're entitled to, the team at My Tax Accountant is there to help. You can reach out to them directly with the details right here for some personalized, expert advice that's tailored to your exact situation. So let me just leave you with this final thought. Think about your own assets. Are you completely confident that you know which of your past expenses actually qualify? Could there be thousands of pounds in tax savings just sitting there, hidden away in your old paperwork? Something to think about. Thanks so much for tuning in.